Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate jargon and financial reports. And for this episode, we've got a juicy Q3 filing that might just make you rethink your investment strategy, especially if you are looking for the next big thing in biotech. Get ready because things are about to get interesting. Before we dive deep, if you love getting clean, no fluff insights from these complex SEC filings, make sure you hit that subscribe button and the notification bell. And if you want to chat about these findings and more, join our Discord community. The link is waiting for you in the description below. Alright, let's get straight to it. We are looking at Fate Therapeutics Incorporated's Q3 10Q filing for the period ending the 30th of September 2025. This is a crucial report for them, giving us a snapshot of their financial health and performance over the last 3 and 9 months. First up, the balance sheet as of the 30th of September 2025, the company shows total assets of about $343 million. Now compare that to the 31st of December 2024, where it was over $440 million. That is a notable drop, folks. Most of this seems tied to their short term and long term investments shrinking, which in a way is not entirely unexpected given current market conditions, but it is still something to watch. On the flip side, their cash and cash equivalents saw a slight increase, going from around $36 million to over $40 million. That is a small positive signal. More cash on hand is usually good. Now let's talk about the income statement, or in this case, the loss statement for the 3 months ending the 30th of September 2025. They reported a net loss of about $32 million. That is an improvement compared to the $47 million loss in the same period last year. Looking at the 9-month period, the net loss was around $103 million for 2025. A better picture than the $134 million loss in 2024 for the same 9 months. It seems they are managing to reduce their losses, which is definitely a step in the right direction. Collaboration revenue took a hit though, dropping from over $11 million in the first 9 months of 2024 to just over $5 million in the same period of 2025. This means their partnership income isn't as strong as it was. Let's look at how they are spending their cash. For the first 9 months of 2025, they used about $82 million in operations. This is a slight improvement from the $95 million used in the same period in 2024. They are definitely spending money on research and development, which is typical for a company at this stage. Their investing activities show they brought in about $83 million in cash in the first 9 months of 2025. Mainly from maturities of investments, which is a positive. In financing activities, they raised about $3.8 million in 2025, mostly from a CIRM award. This is a significant drop from 2024, when they raised almost $97 million, primarily from stock offerings and pre-funded warrants. Okay, now for the really important details hidden in the notes. These tell us why the numbers are the way they are. They mention a corporate restructuring in August 2025, leading to workforce reductions and about $1.1 million in charges. This is often a sign of belt tightening, trying to extend their cash runway, which is understandable for a clinical stage company. Their collaboration with Ono Pharmaceutical is a big part of their story. They've had several amendments to this agreement, with Ono continuing to pay fees for research and development. However, revenue from these collaborations is down, as we saw on the income statement. This partnership is definitely a key focus, with potential for future milestone and royalty payments, but also a dependence on Ono's progress. Then there is the MSKCC license agreement. This one is interesting because it includes stock price appreciation milestones. They achieved one milestone and paid out $20 million back in 2021. The remaining milestones are tied to their stock price, which adds a layer of financial uncertainty linked directly to market performance. The values of these milestones are measured using complex models, and changes in fair value are recognized as expense or income, contributing to their other income and expense lines. They also received awards from the California Institute for Regenerative Medicine, or CIRM. These are accounted for as liabilities until decisions are made to treat them as loans or grants. The FT819 award is for $7.9 million and the FT836 award for $4 million. These are important funding sources but come with future obligations like potential royalties on commercial sales. Looking at their investments, they primarily invest in US Treasury debt, corporate debt, and commercial paper. As of the 30th of September 2025, their total investments were over $214 million at fair value. These are mostly classified as available for sale, meaning they could be sold if needed. But the company states they do not intend to sell those that are currently in an unrealized loss position. This section details how they value certain assets and liabilities. Their financial assets like money market funds and US Treasury securities are valued using level 1 inputs, meaning they are based on quoted prices in active markets. Corporate debt and commercial paper fall under level 2, using other observable inputs. The stock price appreciation milestones, however, are level 3 liabilities, meaning they are valued using significant unobservable inputs. This highlights the speculative nature of these particular obligations. Now, let's talk about their capital structure. They have preferred stock, including 2.7 million shares of class, a convertible preferred stock which can be converted into common stock under certain conditions. They also have pre-funded warrants, which are essentially a promise to issue common stock at a very low exercise price. As of the 30th of September 2025, there were nearly 3.9 million of these pre-funded warrants outstanding. When we look at stock options and restricted stock units, it shows equity compensation to employees. They granted over 3.6 million options and nearly 3.4 million restricted stock units in the 9 months of 2025. Stock-based compensation expense is a significant line item affecting both research and development and general administrative expenses. This is a crucial part of their strategy to attract and retain talent in a competitive industry. And now, for the dreaded but essential risk factors. This section reads like a comprehensive list of everything that could go wrong, which is pretty much everything for a biotech company. They emphasize the novelty of their product candidates and the fact that very few research programs actually result in successful products. They highlight the immense cost of development, the competition, manufacturing complexities, and the dependence on third parties. They also point out the stock price volatility risk, specifically mentioning that changes in stock price can trigger financial obligations under their licensing agreements. Like those with MSKCC, this integration of stock price into financial obligations is a key takeaway here. The risk of not being able to protect their intellectual property is also a recurring theme, which is critical for any biotech firm. Digging into the management's discussion, they reiterate their dedication to cell therapies derived from stem cells, aiming for off-the-shelf treatments. They openly admit to being unprofitable since inception and expecting continued losses. The Ono collaboration is again highlighted as a significant piece of their strategy, with revenue recognition tied to those collaboration milestones. They are heavily investing in research and development, which is eating up a lot of their cash. But they anticipate that these expenses will remain significant for the foreseeable future as they push their product candidates through trials. This is where we see their cash situation. As of the 30th of September 2025, they had about $225 million in cash equivalents, and investments. They acknowledge that they will need substantial additional funding and are looking towards equity or debt financings or future collaborations. The dependence on future funding is a massive risk. With their current burn rate, that cash runway might not last as long as they hope without new capital. The report also mentions the potential impact of inflation, geopolitical tensions, and economic instability on their ability to raise funds. The company is facing some legal challenges, including a securities class action lawsuit and derivative litigation. These are ongoing and could result in significant legal costs and distractions. It is a complex situation involving allegations of misleading statements and breaches of fiduciary duty, which often happens with publicly traded companies, especially those with volatile stock performance. We've already touched on the risks, but it is very important to understand their depth. The company stresses the uncertainty of clinical trials, regulatory approvals, and market acceptance of their novel cell therapies. The manufacturing process for cell therapies is described as incredibly complex and expensive, with potential delays or failures that could cripple their development plans. They're also heavily reliant on third parties for manufacturing and research, which introduces another layer of risk if those partners falter. And here is a stark reminder of the volatility they face, linked directly to their stock price. They mention their stock price has been volatile in the past and could continue to be regardless of how the company performs. This volatility can impact their ability to raise capital and even trigger financial obligations under agreements like the one with MSKCC. They are also conscious of the potential for delisting from NASDAQ if certain price requirements aren't met, which would severely hurt their liquidity. So, what is the story here? Fate Therapeutics is in a high-risk, high-reward game. They are pushing the boundaries of cell therapy, which is incredibly exciting but also brutally expensive and scientifically challenging. Their collaboration with Ono is a significant partnership, but the drop in revenue from it is a concern. They are burning through cash at a rapid pace, and while they have a decent amount of cash on hand, their future hinges on securing more funding and successfully navigating the extremely complex clinical trial and regulatory landscape. The stock price volatility is a double-edged sword, impacting their financial obligations and investor confidence. Their success is heavily dependent on breakthroughs in a rapidly evolving scientific field, and they openly admit that many of their product candidates may never reach the market. The risks are numerous and significant. from regulatory hurdles and competition to manufacturing failures and patent disputes. However, for investors who are willing to accept a high level of risk for the potential of a massive reward, Fate Therapeutics is playing in a cutting-edge field with potentially revolutionary treatments. They are making progress in reducing their net losses, which is a positive sign, but it is a long road ahead with a lot of unanswered questions. They are a classic example of a clinical stage biotech firm where the potential payoff is huge, but the odds are stacked against them. What do you think about Fate Therapeutics' financial situation and their bold approach to cell therapy? Are they on the right track or are the risks too great? Let me know your thoughts in the comments below. If you found this deep dive valuable, please give this video a thumbs up. It really helps us out. And of course, subscribe for more corporate breakdowns. Don't forget to join our growing community on Discord. Linked in the description. Thanks for watching, and I'll see you in the next decode.